Hi, I'm John Fitzgerald and welcome to another edition of Custodian TV. Well, we're right at the end of this financial year and it's been probably one of the most amazing years in our financial history since the Great Depression, they're saying. The stock market's fallen another, well, in total 38%, falling 15% in 2007-8, and then falling another 26% from that low, bringing it down a total of 37%, but it got to a stage where it was right down 45%. Now that is amazing, and that's all happened in such a short period of time. It happened in literally 1 to 2 months, that fall, and the stock market's still not recovering, although they're still talking about, green shoots and optimism, etc., etc. But the main concern has been the amount of money lost in superannuation, because 80% of Australians have superannuation, and the majority of that is in equities and the equity markets. Real estate's been a different story, and I'll talk about that in two phases. Number one's been the commercial story, and then the residential story, and in particular, the residential story when we talk about custodian. But let's talk a little bit about the downturn and what's actually happened. It's come in waves. The first huge wave, or the tsunami of the downturn, was really the banks, Lehman's banks, and the big insurance companies in the States collapsing, caused by a lot to do with the subprime crisis. So we have a financial crisis, and that really took hold quickly, particularly in the United States. Took hold almost immediately. It had an effect in Australia, and the effect was that it dried up credit here. The figures that were quoted to me by one of the senior execs in the bank was that we had 2 or 3 years ago $7 trillion of money to lend in Australia, and now that's been reduced to $1 trillion. So it literally means there's no capital for expansion, for growing, for business. And that's had an effect. But the wave that's hit us, we had the stock market literally crash overnight, and it wiped out a lot of people with margin calls and companies who borrowed on the stock market, and anyone who was significantly in debt, relying on shares, stocks, dividends, etc., has been affected tremendously. And that's had an after effect because it's obviously affected business. The second wave is now banks tightening up credit, and that's affecting business because business can't grow, can't expand. And the third wave is forecast to hit unemployment. And they're expecting unemployment, which they expected it to go up quite a lot more than it is today. It's sitting at around about 5.7, 5.9%. They're expecting it to go to as high as 7 to maybe 8%. Some are even saying it could go as high as 8.5%. I don't know. And I really don't think anybody knows. And it's not really for us to guess. I do know that back in 1991 we had unemployment at over 12%, and I do know the effect on real estate. Now, how has it affected real estate? How has the downturn affected real estate? Well, it's been interesting because it's just starting to have effect in the commercial market. And I wrote in 7 Steps to Wealth about investing in commercial property because there's a whole philosophy of investors who follow the philosophy, I should say, of investing only in commercial property. They're having some real tough times at the moment. Obviously, tenancies are going broke, they're not getting the rental income, but the banks are now winding back their loan value ratios. So the maximum you get on a commercial property is 70%. But the trouble is, if you have a commercial property, the banks are now asking you to get it revalued within 1 or 2 years, and they're wanting you to repay down the loan if the value's fallen. And the values have fallen significantly. 10, 20, sometimes 30%, depending on the location, the type of tenants, etc., etc. So that is really having a carnage effect in the commercial industry. And that's why so many people and funds have gone out to raise money from the public, because they know they can't get money from the banks. And I have my own commercial portfolio, and I have that exact issue where the bank have said to us, okay, we want revaluations, and if your valuations have fallen and your LVRs have come below or gone above 70%, we want them brought back into line to 70%. No problem, I've been through that before, and we're well catered for that. But a lot of investors weren't. Residential is completely different. How's the residential market compared? The top end has really fallen by a good 25%, no doubt about that. And when I say the top end, anything really above $2 million has fallen by 25%. Anything above $1 million, my guess is it's fallen by around 15%. And anything above really 500,000 to $1 million has come off maybe 5 to 10%. Anything under $500,000, now that's been very interesting because we've actually seen it go up a little bit, and we've had even higher valuations on some properties that were valued last year. Main reason, first home buyers in the market, yes, of course, but low interest rates. The lowest interest rates in 50 years has made it so much more affordable for people in that low end. And because we still have this major housing shortage, then we still have this backlog of people wanting to buy homes. Even though, yes, unemployment could rise, and even though, you know, we recognise that first home buyers aren't going to be around forever, we still have this shortage. I go back to the last recession that we had, 1991. What happened? Well, we had a major fallout in the commercial property market where values fell by 30% or thereabouts. That's happened or almost happened today. We had the stock market crash in 87, yes, and we had interest rates though at 18%, unemployment at 12%, and we had a 2-year oversupply of residential property. Today, completely different. We've got almost a 2-year undersupply, particularly in the low end. We've got interest rates at 5%, and they're talking about bringing interest rates down even further. I'm going to talk a little bit about that towards the end, interest rates. And we've also got a situation of supply, as I mentioned, being at a 2-year undersupply, as I said, particularly in the low end. And that's really the market that we've always focused on. Custodian focuses on housing in the median house bracket, the low end of the market, in good proximity to CBDs, that is the main CBDs, in the capital cities. And then, as you know, meeting our location criteria. And that has stood the test of time. The litmus test of this financial downturn is that every other asset class has been affected except for custodian homes. And we've even seen our rents go up. So a real bonus for us. How are custodians faring? They're faring really well, and I see a lot of them now coming and acquiring more, realising that you can purchase a property today costing you around $20 or $30 a week. Great opportunity to increase the portfolio because there's nothing more certain, and you're starting to read about it in the newspapers today, that we're going to be led out of this downturn by a residential housing boom. That is for certain. That's part 1 of our update. If you're interested in further information, please tune in for part 2. Thank you for listening to me.